we want you to know.
The U.S. economy is at a pivotal moment. While inflation has eased, economic growth has started to sputter, raising concerns about a potential recession. Against this backdrop, many are urging the Federal Reserve, the nation's central bank, to lower interest rates as a way to stimulate the economy and prevent a downturn. But with each interest rate cut, there are those who warn of a resurgence in inflation or the creation of financial bubbles. So the question remains, should the Fed take this plunge? To understand the arguments for lower rates, let's break down the current economic situation and the potential consequences of the Fed's actions. The case for lowering interest rates boils down to several key points. First and foremost, boosting economic growth. The primary objective of the Federal Reserve is to foster economic growth and stability. When the economy shows signs of slowing, as it has recently, the Fed may intervene to prevent a recession. One way they do this is by lowering interest rates. By reducing rates, the Fed aims to make borrowing more affordable for individuals and businesses, thereby encouraging spending and investment, both of which fuel economic growth. Lower rates can also bolster stock market performance. This can be a self-fulfilling prophecy, as a rising stock market can lead to increased consumer confidence and more robust spending. Secondly, addressing the housing market crisis. The housing market is extremely sensitive to interest rate changes. High rates increase mortgage costs, potentially leading to a decline in home sales and even a housing market crash. This seems to be part of what's happening with the ongoing slump in the housing sector. If rates are lowered, mortgages become more affordable, which can prop up the housing market and avoid a significant downturn. This can benefit prospective homeowners and also help stabilize the broader economy, as the housing market accounts for a substantial portion of economic activity. Furthermore, lower interest rates could offer relief to cash-strapped consumers and businesses. During tough economic times, both individuals and companies may struggle with debt payments due to factors like high credit card balances or adjustable-rate mortgages. By reducing rates, the Fed eases the burden of debt repayment, freeing up more of people's and businesses' disposable income. This can help prevent defaults and keep money circulating in the economy. Additionally, lowering rates can be beneficial for exporters. In an increasingly globalized economy, exports are crucial for many businesses. However, when the U.S. dollar strengthens due to higher interest rates, as we've seen in recent times, it can make American products more expensive in foreign markets. This reduces demand for exports. By lowering interest rates and weakening the dollar, the Fed can make U.S. exports more competitive on the global stage. In addition to these points, proponents of lower rates often cite the concept of the neutral interest rate, which is an interest rate that neither stimulates nor restricts economic growth. When interest rates are above the neutral rate, borrowing becomes more expensive, potentially slowing the economy. Conversely, when rates are below the neutral rate, the economy may overheat. Some economists argue that the Fed has miscalculated the neutral interest rate, setting rates too high and contributing to the current economic slowdown. In this scenario, lowering rates would bring them closer to neutrality, balancing the scales between inflation and growth. On the other hand, critics of lower rates argue that doing so carries inherent risks. One major concern is the potential rekindling of inflation. Lowering rates can inject more money into the economy, potentially leading to excessive spending and a surge in prices. This could pose a serious threat to the hard-earned progress made in curbing inflation. Additionally, rate cuts can contribute to asset bubbles in areas like the stock market or real estate. When borrowing is cheap, investors may pour money into these markets, inflating their values beyond their intrinsic worth. When the music stops playing, as it always does, this can lead to a crash that negatively impacts the wider economy. Furthermore, critics argue that interest rate cuts don't address the root causes of economic issues. For example, if the economy is stagnating due to a lack of consumer demand, lower rates won't fix the underlying problem. Instead, they may only provide a temporary boost followed by a more pronounced slowdown when the stimulus wears off. Moreover, in an era of globalization, the Fed's actions can have global repercussions. When the Fed lowers rates, it influences other central banks worldwide. This can weaken the dollar and impact exchange rates, potentially causing instability in other economies. Ultimately, the decision of whether or not to lower interest rates is a complex one with far-reaching implications. The Federal Reserve must carefully weigh the potential benefits for economic growth, the housing market, and consumers against the risks of reigniting inflation, creating asset bubbles, and upsetting global markets. Only time will tell how this delicate balancing act will play out and what the ultimate impact will be for the U.S. economy and the millions of people it encompasses. In recent years, the United States has faced a unique set of economic challenges. After the Great Recession, the country experienced a period of slow but steady growth alongside low inflation. However, the economic landscape shifted dramatically with the emergence of the COVID-19 pandemic. The pandemic-induced economic shutdown led to massive government stimulus packages and a subsequent surge in spending. Coupled with supply chain disruptions and pent-up demand from 2 years of the pandemic, this fueled a sharp rise in inflation, reaching levels not seen since the early 1980s. In response, the Federal Reserve took swift and decisive action to combat inflation. It began raising interest rates in March 2022, marking the end of an era of near-zero interest rates that had persisted since the financial crisis. The rate hikes were aggressive, with the Fed aiming to make borrowing more expensive and cool down the overheating economy. As of October 2023, the federal funds rate, the target range for overnight lending between banks, sits between 5.25 and 5.5%, the highest level since August 2004. However, as the Federal Reserve tightened its monetary policy, the economy showed signs of strain. The housing market, extremely sensitive to interest rates, plummeted with a sharp drop in home sales and a slowdown in construction. Consumer spending, a key driver of the U.S. economy, also took a hit. With higher borrowing costs, people cut back on non-essential purchases, impacting businesses across the country. As the economy started to show cracks, concerns of a recession grew. A recession is generally defined as 2 consecutive quarters of declining GDP. Technically, the U.S. entered a recession in early 2022, meeting this definition. But recessions are not officially declared until months after they begin. The worry is that the combination of high interest rates and persistent inflation could push the economy into a prolonged downturn. In this context, calls for the Federal Reserve to lower interest rates have intensified. Proponents of rate cuts argue that with inflation largely under control and the economy teetering on the edge of a recession, it's time to shift gears. They contend that lower rates will boost economic growth, prevent a deeper recession, and provide relief to consumers grappling with high living expenses. On the other hand, critics of rate cuts caution that doing so could reignite inflation and undermine the progress made so far. They argue that the Fed should hold off on rate cuts until there is clear evidence that the economy is on a sustainable path to growth without excessive price hikes. Federal Reserve Chair Jerome Powell has acknowledged the dilemma. He has indicated that the Fed is prepared to pause its rate hikes to assess the economy, but has also stressed the need to remain vigilant against inflation. The decision the Fed ultimately makes will have profound implications for the U.S. economy and the millions of people it encompasses. If the Fed chooses to maintain high interest rates, it could deepen the economic slowdown, increasing the risk of a recession and prolonging the period of high living expenses for consumers. On the other hand, if the Fed opts for rate cuts, it could reignite inflation, derailing years of progress and possibly necessitating even tighter monetary policy in the future. As the Fed ponders its next move, it faces a multitude of uncertainties. Will rate cuts provide the economic boost they anticipate, or will they lead to a new wave of inflation? How will global markets react to a shift in U.S. monetary policy? And what will be the ultimate impact on consumers and businesses? One thing is certain: the decisions the Fed makes in the coming months will shape the economic landscape for years to come. The case for lower interest rates is gaining traction in the face of a slowing U.S. economy and persistent concerns about a recession. Proponents argue that rate cuts are necessary to boost growth, support the housing market, and alleviate pressure on consumers. However, critics caution against the potential risks of reigniting inflation and creating asset bubbles. As the Federal Reserve weighs these arguments, the economic fate of the U.S. hangs in the balance.